What if the market's quiet confidence hides a ticking time bomb? On September 4th, 2025, U.S. stocks climbed steadily, buoyed by easing Treasury yields and a collective sigh of relief that inflation might finally be cooling. But here's where it gets controversial. Investors are betting the economy can slow without collapsing, yet whispers of a lurking recession still echo in boardrooms. Let's unpack this delicate balancing act and why the next few days could tilt the scales. The big picture. Major indexes closed higher, driven by large-cap growth stocks and cyclical sectors like consumer discretionary. Treasury yields, which had been climbing, took a breather, giving a boost to riskier assets. Meanwhile, the dollar wavered, and oil prices dipped as traders weighed global demand against OPEC+ supply moves. Gold, however, held its ground, acting as a hedge against uncertainty. Why this happened? The short version. The market is clinging to the soft landing narrative. Slower hiring and moderated wage growth are seen as a recipe for disinflation without economic freefall. This logic favors longer-dated assets and quality growth stocks, especially when yields dip before a major data event like the upcoming JOLTS report. Deeper dive. What's really driving this move? Recent labor data tells a story of normalization. Jobless claims are down, but hiring is no longer explosive. For investors, this is a double-edged sword. It gives the Fed room to cut rates gradually if inflation eases, but it also raises questions about corporate profit margins. The market's message? Proceed with caution, but not fear. Traders are adding risk, but they're doing so with a seatbelt on. Sector spotlight. Who won and lost? Leaders. Technology and consumer discretionary sectors led the charge. Tech's AI-driven infrastructure and chip makers drew attention, while consumer stocks with strong pricing power and lean inventories gained traction. Mixed results. Industrials showed strength, thanks to visible backlogs, but financials were split as banks juggled interest rate expectations with funding costs. Healthcare remained a steady performer in diversified portfolios. Laggards. Energy stocks trailed as oil prices softened. Utilities and staples held steady, reflecting a market more comfortable with risk-taking than fleeing to safety. Commodities. Oil dips, gold holds on. Crude oil gave up recent gains as traders hesitated to bet on demand during the summer lull. Gold, however, stayed near record highs, acting as a buffer against geopolitical jitters and policy shifts. Copper remained range-bound, caught between short-term construction slowdowns and long-term electrification trends. Company news. The hidden drama. Even outside peak earnings season, individual stocks stole the spotlight. Firms that reaffirmed guidance or showed cost discipline outperformed. Conversely, companies hinting at weaker consumer spending or slowing billings faced investor skepticism. In tech, the focus shifted from revenue numbers to metrics like customer retention and backlog quality. Technical takeaway. Where to watch. Major indexes remain above key moving averages, suggesting a constructive trend for now. Momentum indicators are neutral to positive, leaving room for volatility ahead of the jobs report. Support levels lie near recent lows and 50-day averages, while resistance aligns with prior highs. A strong breakout could signal a new bull phase. A stumble might trigger a consolidation phase. Investor strategy. The barbell play. Portfolios are leaning into a barbell approach. High-quality growth stocks on one end, and selective cyclical plays on the other, with defensives as a safety net. Fixed income blends of treasuries and corporates are popular for yield and flexibility. For tactical players, options are key for managing event risk, especially with the jobs report looming. What's next? 5 catalysts to watch. 1. Non-farm payrolls, Friday. Jobs added, unemployment, and wage growth will define the Fed's rate cut timeline. 2. Services PMIs ISM. New orders and pricing data will reveal if demand is still resilient. 3. Fed signals. Any hint of tolerance for slower growth could reshape market expectations. 4. Energy shipping. Supply decisions and geopolitical tensions remain wildcards. 5. Company updates. Guidance changes in AI-driven sectors could shift ETFs even on macro-heavy days. Bottom line. Today's gains reflect cautious optimism. If Friday's jobs data confirms a cool but resilient economy, the soft landing story holds. But a hotter-than-expected print, especially on wages, could send yields soaring and test today's progress. For now, the market is walking a tightrope, rewarding companies that prove they can grow cash flow while bracing for volatility. The question is, are we seeing a sustainable recovery or a delayed correction? Share your thoughts in the comments. Do you believe the soft landing narrative, or is a hard landing just around the corner? Editor's note: this analysis is for educational purposes only. Markets are unpredictable. Always do your own research or consult a professional before investing. Copyright 2025 STL News. St. Louis Media, LLC. All rights reserved. Content may be AI assisted but reviewed by humans. For more, visit STL News.